All right, so I lied to you. We need to go ahead and do this on a video because I want to spend class time totally working through one of the problems I posted online today. Um, so at the end of a lease deal, we have to have an action taken, right? Either the lessee is going to purchase it or they're going to return it back to the lessee. And of course, that's going to be centered around some items where uh, we are either going to purchase it with a bargain purchase option, whether the title just absolutely transfers, whether we have a guaranteed residual value, and that will affect the lessee because if they don't have the inventory, or I'm sorry, the leased asset at its guaranteed value, they're going to have to make up for the shortfall with cash. You will be able to figure out the exact effects of these journal entries because you're going to be able to use time value of money in order to determine what the remaining amount of lease liability or lease receivable is to the lessor or the lessee. So case 5 is all about looking at different the different interesting situations, I should say, in which we are turning a lease over. We have Barney and Rufus. Rufus the lessee and Barney's the lessor. We have annual beginning of year payments of $100,000 that are due for 10 years. In the initial case, I have a purchase agreement at the end of the term for $40,000, which is considered a bargain. The equipment has a fair market value of $605,427, and there's a cost to Barney, the lessor, of $400,000. Again, I want you to assume that this $605,427 is going to be equal to the present value of the leased asset. So that we can record it correctly in each situation, right? So let's look at what happens with a bargain purchase option. In a bargain purchase option, remember, the lessee is going to be likely to pay this item in cash and extinguish any remaining liability with this payment. Now, when this occurs, they would have a lease liability. They would have some amount of interest payable, and they would pay cash. The cash is the easy part. If the bargain purchase option is for $40,000, then the cash would be for $40,000. Now, what is the lease liability at this date? Remember, this is going to be, if this is January 1st, 2007 that we entered into this contract, and each payment is a beginning of the year payment, if we've gone 10 years, then we're going to have the final payment being paid at the beginning of the last year. So at 1/1, they would have made a payment. At 12/31, this is the final cash offering, which is the BPO. Okay. So what is the lease liability going to be prior to that? Well, all it is a present value with a future value of $40,000. The payments are done for. We made that final payment at the beginning of the last year. We have an N equal to 1 period because we're measuring it from the last time we reduced it, remember, is January 1st. And my I in this case was 14%. And so that present value would turn out to be $35,088. So I just used that present value formula in order to figure out $35,088. That's the lease liability that would be remaining on the lessee's books at the end of the final year. The interest that is payable is the interest that arises from taking $35,088, multiplying it by 14%, And then notice that this exactly equals or equates to the cash value that I would have to pay on this final term. Now, remember, essentially, even though the payments have been made, there's one more thing that the lessee has scheduled into their liability that remains to be satisfied, and that's that $40,000 payment. That $40,000 payment still is not up to $40,000 because the last time it was adjusted with a cash payment was at the beginning of the year. It still has one more period to earn interest. That interest is that amount right there. Okay. And, actually, if we're going to be technically precise, that would be interest expense, not interest payable. It would be interest payable at the beginning of the next year, but we're going to pay it off, say on 12/31, since I already said that. Okay. Doesn't matter. If you wrote interest payable, not going to take anything off. That seems like a very small detail in the grand scheme of things here. Now, what's it going to look like from the lessor side? The exact same thing. The lessor and the lessee both include the bargain purchase option in their minimum calculations, in their liability, and their receivable. And so as long as the interest rate is the same for both parties, the accounting is going to look exactly the same, only mirrored, so that we have a $40,000 cash receipt from the lessee to the lessor. We would extinguish the lease receivable, which would be at the same amount that the lease liability was for the lessee, and we would have interest receivable or interest revenue. I think you understand the difference between the two, so I'm not going to be too worried about what you call it. All right? That's the bargain purchase option. So now I say, well, what would have happened if we had a GRV rather than a BPO, and it was $40,000? Well, the big difference here is that the lessee will turn the asset over to the lessor. So we don't have a bargain purchase option, which means that now the lessee is going to have to remove the asset from its books. Well, the fair value of this GRV will still be the same. It's a guaranteed value, so the lessee has it recorded in their lease liability, the lessor has it recorded in their lease liability, and so that doesn't change at all. What does change in this circumstance is that, again, the lessee has to remove the lease from their books. So the lease liability is still going to be at the $35,088 mark, given that we have a future value of $40,000, one period from its maturation. The interest expense is going to be the same amount. The big difference is we're not turning over cash anymore. We're not buying this thing, right? So the lessee is not buying it. What they're going to do instead is give back an asset that has a residual value of $40,000. Remember, the leased asset was originally recorded at $605,427. And since it has a GRV attached to it, it would have reduced this lease asset down to the salvage, well, for their purposes, depreciation, down to the residual value of $40,000, which means that in total, they would have recognized accumulated depreciation of $565,427. Notice then the difference between these two numbers is the residual value of $40,000. All right. So Barney the lessor looks at it a bit differently. They get back some inventory. They're not receiving cash. They're getting back their leased asset at a value of $40,000. The interest receivable, the interest revenue and the lease receivable are again going to be the same as the lessee in this case, the same as they were under the BPO, because the lessor includes this in their capitalization of the lease receivable. Right? They both record a guaranteed residual value. They both expect to get that back. And so they would both have a future value, no payments left in the final year, that has a year left at a 14% rate. That's what drives the calculation of these two amounts right here, just as it did in the BPO. The only thing that changes, again, instead of cash, we're getting inventory. Instead of giving up cash, the lessee is giving up or writing off the leased asset on its books. Now let's talk about what might happen if we don't meet the GRV, right? So if we don't meet the GRV, then we have an issue where we owe some extra money as the lessee. The lease liability does not change, nor does the interest. Again, we still have a guaranteed residual value that is recorded by both the lessee and the lessor at $40,000 and is one period away from its final terminal value and at a 14% rate. So this is its present value at the beginning of the year. We're getting rid of that by making this final terminal entry to end the lease. So in this case, we're giving up a leased asset that has only $10,000 of value. I'll explain that in a second. Whoa, how did they get it down to $10,000? I thought it was $605,000 and some extra cents, right, on the end. Yes, I understand. They have to make cash for the shortfall. So they would provide $30,000 of cash. And again, we totally extinguish the amount of lease liability and the interest expense that would have accrued in that final year from that final GRV maturing to its future value over the course of 1 year. Now, the leased asset only being at $10,000, how could this have happened? Why don't I have any accumulated depreciation? It might be linked to something we studied in chapter 11, right? Impairment. Remember that when we impair the asset, we would wipe out any accumulated depreciation, restate the leased asset at its now fair value, and record an impairment loss. So the impairment loss isn't a part of this, but that's how we got down to a $10,000 value for the leased asset. Barney the lessor gets back its inventory at a $10,000 price tag. The cash would be $30,000. The interest receivable would be $4,012, and the lease receivable would still be $35,088. My apologies. Right? What would happen if this lease contained a UGRV rather than a BPO and the asset was worth $40,000 at the end of the term? Right. Well, if it has a UGRV rather than a BPO, Rufus the lessee is going to just have accumulated depreciation and a leased asset for an equal value. Whatever it was capitalized at, it's going to have reduced everything. Because remember, depreciation expense with a UGRV is typically going to be the leased asset, its capitalized cost, minus 0 divided by the lease term. So that means that by the end of the lease term, we will have recorded the entire amount of leased asset in my accumulated depreciation, since there is no residual value that we are aiming toward, right? In the case of the GRV, we had a leased asset less accumulated depreciation of $40,000, because with the GRV, this is the convention that the lessee was using to depreciate the asset. So it's going to be at whatever its cost would have been when it recorded the capitalized cost of the leased asset. I will just, assume that there would be it still comes out to 605, 427, just for simplicity's sake. We are aware that perhaps it should be lower than this amount, simply because the lessee does not record a UGRV, but I just didn't calculate the amount without the BPO GRV in there. Barney, the lessor, is going to be the interesting part of this. Because remember, the lessee doesn't care about the UGRV. They don't have that as a future value. That's why there is no lease liability or interest expense. They don't have to take care of that. Their final interest payment is what actually took care of that arrangement. Barney, the lessor, on the other hand, is going to receive a leased asset, and I said it's at its unguaranteed value of $40,000. They have recorded the future value of $40,000, because remember, the lessor records UGRV. So they would have the present value where we have a future value of $40,000 1 year from the date at an I of 14% with no payment, which gets us what we've seen before, a lease receivable of $35,088 and interest receivable or interest revenue of $4,912. Now, what happens in this case where we have a UGRV, it's $40,000, but the asset's only worth $10,000? Rufus, the lessee, doesn't change. They didn't record a future value with this UGRV. They have no lease liability. They have no interest expense to record in that year. So we would just repeat that journal entry where we totally wipe off the leased asset, debit accumulated depreciation, credit the leased asset. They don't have to record a loss. They don't have to record cash going out. Even though they didn't meet the UGRV, it wasn't guaranteed. They don't have to pay anything. So Barney the lessor gets the shaft on this one. Leased asset would only come up to $10,000. They have interest, revenue, and a lease receivable for $35,088 and $4,912. This doesn't make up for what they got, right? They're getting rid of a receivable and revenue, recording some revenue, and they don't have the amount that they need. So we record a loss on lease contract for the difference. So they absorb a loss. Lessee doesn't care. They weren't guaranteeing anything. Here, in the final case, I have another UGRV where they have a $40,000 UGRV, and the asset's actually worth $75,000 according to a fair value estimate. Well, Rufus the lessee wasn't aware of this UGRV, didn't include it, doesn't have a fair value, future value, so they just debit the accumulated depreciation, credit the leased asset. Barney the lessor is happy, but cannot record the leased asset at its superior value. Right? This is a situation of conservatism where we only stipulated a UGRV equal to 40,000. We cannot record a gain on the transaction because it came in at a higher price. The only time we can do that then is if we release it or sell it. And then we can recognize the appreciated price. So if we sold it for 70, we have it on our books for 40, that's when we recognize the gain. It's very similar to inventory where we record a write down, i.e. it coming back at $10,000, but do not record a write up. I anticipate that there will be some questions in class about these procedures, and I welcome them because this is probably one of the trickier parts of the leases, as if it weren't tricky enough already. All right, thank you.